Corporation tax in the UK. Watch my video and I'll explain all about this area. If you haven't yet, click the bell and subscribe to be notified every time we produce our best pieces of content. Corporation tax in the UK. What is it and who has to pay it? Watch my video to find out more. Corporation tax is tax payable by all companies that are registered at Companies House. Now, if a company makes a profit during its year, it will pay corporation tax based on those profits. Now, currently as we sit here, there's two rates of corporation tax. There's a large rate of corporation tax at 25% and a smaller corporation tax rate at 19%. Now, be mindful. The additional rate of corporation tax starts when you earn over 50,000. So if your company currently earns 50 grand profit or less, you'll pay 19%. But additionally, the additional that it makes over 50,000 and between 200 will be taxed at 26.5%. Now, you may think that that's slightly an odd rate, but that rate is designed that's known as an effective rate. So the rate between 50 and 150 will basically, by the time that you get 200,000, would mean that you're paying 25% tax on the whole lot. So there's tax planning opportunities if you're 25%, there's tax opportunities at 26.5% and tax opportunities at 19%. So make sure you've got these well versed with your accountant. Now, corporation tax is registered on what's known as a company tax return called a CT600. This CT600 is filed with HMRC on an annual basis normally, not unless you've had an either shorter or longer year end. Now, on that corporation tax return, you will attach your full set of accounts. That will give HMRC the information to understand exactly what your profits are and how you've calculated your tax. And if they want to, they can come and investigate, which basically means check up with your tax calculation. But each year, your accountant or financial advisor will tell you exactly what your corporation tax is and when it should be paid. As long as you haven't changed your year end, your tax will be payable 9 months after your year end. So you've got a little bit of time after your year end to prepare for it. What we suggest with every single business client is, why don't you get your corporation tax calculated in, done and return sent in 3 months after the year end. Even if you haven't planned for your corporation tax and you don't have money put aside, you've got 6 months to prepare for it. So make sure that you don't fall into that trap on where you're preparing your accounts 8 months and 3 weeks after the year end, and then someone slaps in a corporation tax bill where you go, damn, how am I going to pay that? Now, paying your corporation tax is quite easy. And I've got a little tip here as well. For paying your corporation tax, you'll have a reference code that your accountant will be able to give you that you can pay it online. Easy, no problem, no hassle. What a lot of our clients do is they say, right, okay, thanks for letting us know what our corporation tax is, Michael, but we want to chip away at this because it feels better for us on paying it earlier. Now, I actually like paying tax earlier because you get normally a better rate of return from HMRC than you would do in the banks. Now, it goes against everything I was taught at accountancy school, which was keep the money in your bank and pay it as late as possible. But currently, HMRC are paying you a 4% annual return on that money if you're paying it early. So number one, it's going to do your street cred no harm if you're paying your tax early. That's got to only do you favours. And secondly, if HMRC are going to pay you interest on that money earlier than what you're getting currently in your business bank account, it is a win-win. Now, I'm not saying this at the expense of not being able to meet your other cash flow needs. I would never say that in a million years. But what I'm saying, if you've got the availability there, or if you like chipping away at things over 6 months where you just bring it down, because that's just how you're wired and that's how you roll, I fully commend you on doing this. And at the minute, they're paying a really attractive return on this money. So would you rather leave your money in the bank or give it to HMRC and get a better return? I think this is an opportunity that a lot of small businesses miss. Ways to reduce your tax bill. Number one, don't make any profit at all. So if you make zero profit, you are not going to pay any money in tax. Why would you do that? You'd be surprised. Make sure all these decisions are centered around improving your net profit. Don't make all of your decisions on a tax basis. If you make your decisions on a tax basis, you'll spend a load of stuff in your business that you don't really need just to get your corporation tax bill down. It is madness. A second problem that I come across a lot is where clients have set themselves up on a payroll system. So they've taken all their money out via salary. When a lot of the times, a lot of small businesses can save thousands of pounds instead of doing a full salary, doing a salary and a dividend. So make sure that you're optimized for the way that you take the money out of your business in the best way possible. One of the services that we call that at MDH is remuneration planning. Now, with the current tax legislation that we've been through in the last 2 years, it's been a bit of a pantomime. It's gone up, it's gone down, we've had kamikazes, we've had all types of stuff that have just changed really quickly. So make sure that your advisor and your accountant is up to date with the current legislation. You're doing things that are not based on tax planning in 2006. I'm talking about tax planning now. And currently we sit here in 2023, but in 2023 you want to know the rules, 2024 you want to know the rules, and you want to optimise it as much as possible. Because who wants to pay more tax than they need to pay? Make sure you're also claiming reliefs. A really good one that gets missed a lot is property development companies. So if they're remediating land that's been damaged or contaminated, there's extra release for that. If you're creating new items that are brand spanking new and not to the market, you can get released like R&D tax credits. You can also get capital allowances on commercial properties as long as it hasn't been claimed before. You could also get loads of other reliefs that may be relevant for you and your business. So are you claiming the right amount of reliefs for you? Now, one thing to be mindful of, the rates that I said earlier in this video of 50,000, if you've got two companies that are controlled by the same ownership, say husband and wife, them two allowances go in half. So you'll pay 19% on the first 25% profit if you have two companies that are known as associated. And if you've got a 3, divide it by 3. If you've got 4, divide it by 4. Now, where this is really relevant for a lot of business owners that we work with, we've worked with loads that have built their own property portfolios. And for the last X amount of years, for a while now, it's been more beneficial to hold them within a limited company. So immediately, if you've only got one business that you control and one property company, you're already dividing that allowance by 2. So where it was quite fashionable to have lots of different companies, where you had a bit here, a bit here, a bit here, a bit here, I think that's changed. So if you've got loads of companies that are not really serving a purpose, just be mindful because you may be losing allowances, as well as racking up additional professional fees with accountants, whatever cost that you have in admin to run that company that you may not need. So really give that a really good look. What you've also got as well to remember is the basics. You pay tax on the amount of profit your business earns. So it's all well and good scouring everything for everything you can to reduce it and get every cost that you can measure it, but you can only go so far. So sometimes once you know that you're optimized in the most efficient way possible, you've claimed every relief you can and claim every overheads, then paying tax is good. Why is that? I'll tell you why it is because you're making a load of profit. And if you're paying 25% tax on your corporation tax, that potentially will be good. Now also you've got other strategies that you can implement as well, like pensions. Now currently in the market, business owners can put £60,000 into a pension each. Now I think that's phenomenal because you've got potentially a 25% tax saving going in and you're paying no personal dividend tax on it as well. Now dividend tax can be 33% or more if you're a high rate taxpayer. So if you're saving the 25% corporation tax plus 30% dividend tax, you are almost doubling your money overnight. So by allowing yourself to put money into a pension could reduce your tax even further. Now, just remember, everything changes. Make sure all of the advice that you take around corporation tax is in line with your business and personal goals. And make sure it's up to date in the legislation. Because I've lost count of the amount of people that are giving advice based on old legislation. Make sure you don't fall into this trap. I hope you found this video of interest, and if I can help with any further questions, please contact me. Click my Calendly link below. I'll take on board any questions you have. There'll be no pushy sales pitch, and you never know, we may end up working together.